Most property investors are playing the game completely wrong. They save up £50,000 and put it down as a deposit, buy one property and then spend the next 2 years saving up for the next deposit. And their capital is working, but it's pretty lazy. Maybe getting a 6 to 7% return, but it's tied up for years. But there's a glitch in how UK property works. A way to recycle your capital so you only leave £40,000 in a deal. And that £40,000 works 3, 4, and 5 times harder than a normal buy-to-let deposit ever could. It's called capital recycling through HMO conversions, and it's exactly how I'm going to build my portfolio. In this video, I'm going to break down exactly how this works, the real numbers, the process, and why most investors never figure this out. Hi, I'm Jim Holland from Dan & Jim Property, which I run with my brother in the northwest of England. We buy houses and rent them out either as whole properties or by the room. I've recently just completed my first HMO conversion, transforming a 3-bed house into a 6-bedroom property, and raised £160,000 in private investor funds to make it happen. Right now, I'm focused on filling my pipeline with 3 to 5 projects over the next 12 months. And my bigger vision is to create freedom for myself and others through property, whilst providing high quality accommodation that people are actually proud to call their home. And in this video, I want to show you the exact mechanics of how we structured that deal to leave minimal capital in, whilst maximizing returns. And in today's video, we're going to cover 3 things. 1, why traditional buy-to-let traps your capital. 2, how commercial valuations change everything. Number 3, the exact maths on how £400,000 can control 10 properties worth £4 million. Quick thing before I dive into the video. If you're sitting on capital, whether that's 500,000, 1 million, or all the way up to 5 million, and you're looking at how to deploy it into property without becoming a full-time landlord, there's a link in the description to our investor waitlist. We partner with private investors on HMO conversions. You provide the capital and we handle everything else. And we have a 50-50 profit split. It's not for everyone, but if it is for you, there's a link in the description below, and let's get into it. Let's start with how most people invest in property. You save up a deposit, let's say £50,000. In the north of England, places like Bradford, Burnley, and parts of Liverpool, that 50k could actually get you 2 deposit pots on 2 properties, 25 grand each. 2 buy-to-lets, you feel diversified and you're gonna feel great. And each property rents out for say £600 a month. After mortgage, insurance, maintenance, and management, you're probably netting £150 to £200 a month per property. So that's around about £4,000 to £4,500 a year, which you're making from the £50,000 invested. 8 to 9% return, which isn't bad, but here's the problem. Your £50,000 is now locked in across those 2 properties, and you can't touch it. You can't redeploy it. It just sits there. So what do? You start saving again. And that's another 2, 3, maybe even 4 years to build up your next chunk of capital. And this is why most landlords get stuck at the 3 to 4 property range. Their capital's trapped. The maths just doesn't let them scale. And here's what most people miss. There's a completely different way to structure property deals. Now let me be clear, you're always going to leave money in deals. Chasing all money out deals is pretty dangerous. You can end up being over leveraged, it kills your cash flow, and it adds more risk which you just don't need. It also leads to you chasing the perfect deal and never pulling the trigger. Remember this one key thing. Time in the market beats timing the market. But with HMO conversions, 2 things happen. Number 1 is you can leave less capital in each deal. Not 25 or 50, more like 40 grand in a much higher value asset. 2, and this is the key one, the money you do leave works significantly harder for you. Not 8 to 9%, more like 30, 35%, sometimes higher. Less capital left in and higher returns on what stays in. That's the big difference. And let me show you how this works. The glitch is this. HMOs are valued differently to normal residential properties. A standard buy-to-let is valued on comparables. What did similar houses on the same street sell for? That's your valuation. But certain HMOs, they get valued commercially, based on the income they generate. And this changes the game. Let me show you with real numbers from my first conversion. We bought a 3-bedroom house. The purchase price was £134,000. Then we spent around £200,000 on the conversion, the refurb itself, the financing costs, and all other associated costs to get it over the line. So all in, we were roughly at £340,000. Now, if this was valued as a standard residential property, we'd be looking at similar comparables. Similar houses on the same street. That 3-bed, even fully refurbished, might be worth 180, maybe £200,000 as a normal house. If that was the valuation and we refinanced at 75% loan to value, we'd pull out £150,000 max and have nearly £200,000 stuck in the deal. That's an absolute disaster. That's not a glitch, that's just bad math. But here's where it gets really interesting. Our property isn't a standard house anymore. We've converted it into 6 studios, all with en suites, and it's a completely different asset now. And because of the nature of the conversion, the number of tenants, the layout, and the fact it can't easily be turned back into a normal residential property, it therefore qualifies for commercial valuation. Now, quick note on this, not every HMO gets valued commercially. Typically, you need 6 beds or more. The rooms usually need to have en suites, and a lot of the time they're studios as well. Now, you can sometimes get a commercial valuation on a 5-bed, but 6 beds and above with en suites is where it becomes more reliable. The surveyor doesn't just look at what the house next door sold for, they look at the income the HMO generates, which is why it's important to know what you're doing, and the best way to do that is to make sure you subscribe to the channel. So our valuation came back at £400,000. Now, we refinanced at 75% loan to value. 75% of 400,000 is 300,000. We were all in for 340 and we pulled 300 back out, which means we leave £40,000 in the deal. That's the glitch. We've taken a £134,000 house and converted it into a commercial asset worth 400,000, and we've only got £40,000 of our own capital tied up into it. And remember what I said earlier, that £40,000 isn't lazy capital earning 8%. Let's do the maths. We make £4,100 a month gross rent. After all costs, mortgage, bills, maintenance, management and voids, we're netting around £1,200 a month. That's £14,400 a year. On £40,000 left in, that's 36% cash on cash return. £40,000 working at 36%, not £50,000 working at 8%. That's why this strategy is so powerful. Now let's talk about what this means for scaling. Most investors think in terms of deposits. I've got £400,000, that's 16 deposits at 25k each. So they can buy 16 properties in the north of England. And then their £400,000 is gone, locked up. They're done until they can save up more money or sell something. But watch what happens with capital recycling. You've got £400,000. You do your first HMO conversion and the all-in cost is £340,000. Now you're not funding all of this yourself. You might use bridging finance, development finance, and maybe some private investor capital to get the deal done. But after refinance, you've got £40,000 left in your deal and the rest of your capital back to recycle. You do it again, another £40,000 left in a deal, and again and again. By the time you've done 10 conversions, you've got 10 properties worth £400,000 each. That's £4 million in assets, generating over £40,000 a month in gross rent. And your total capital left across those 10 deals is £400,000. The same £400,000 that would have bought you 16 standard buy-to-lets with lazy returns. It now controls £4 million in high-yielding HMOs. And here's the thing, those 16 buy-to-lets might have netted you £2,000 to £2,500 a month in total. These 10 HMOs net you £12,000 a month. Same capital, completely different outcome. That's the infinite money glitch. You're not spending your capital, you're recycling it. And every pound you leave in works 5 times harder than it would in a traditional buy-to-let. Now, before you think this is some sort of magic trick with no downsides, let me be straight with you. This strategy works, but it's not easy and it's not without risk. Downside number 1, you need access to more capital up front. You can't do a £340,000 conversion with a 25k deposit pot. You need bridging finance, development finance, or private investors to fund the purchase and refurb. And that costs money. Bridging rates might be 0.75% to 1% per month, and that adds up fast, particularly if your project overruns. Downside number 2 is valuations aren't guaranteed. I told you our property came back with 400,000, but what if it come back at 360? Now you're only pulling out 270, and you've got £70,000 stuck in the deal instead of 40. The commercial valuation depends on rent being achieved, the spec being right, and the surveyor agreeing with your numbers. And that's not a certainty. You need to know your numbers before you go in. You need to be confident in the valuation will stack up, because if it doesn't, you're going to trap more capital in the deal. Downside number 3, refurbs can overrun. We budgeted around £200,000 all in for the conversion, finance and other costs. What if it was 230 or 250? Now your all-in costs are higher and your margins have been squeezed, and you're going to leave more capital than you planned in the deal. And refurbs can go wrong. Contractors can let you down and you can find problems you didn't expect. That's just the reality of building. Downside 4, this takes time and expertise. Finding the right property, managing the conversion, dealing with planning and licensing, getting the tenants in. This isn't passive, it's a full-on business. If you don't have the time or the knowledge to do this properly, you're gonna make expensive mistakes. So why do I think this is the best strategy for building wealth through property? Because in my opinion, the upside is asymmetric. Yes, there's risk. Yes, it takes work. Yes, you need access to capital and finance, but if you execute correctly, you're building a portfolio 5 to 10 times faster than traditional investors, with significantly better returns on every pound deployed. The people who figure this out at scale are the people who don't stay stuck at 2 to 3 properties forever. Here's the reality though. Most people watching this have got capital. That's not the problem. The problem is time and expertise. You've got a business to run, a career, and a family. You're not going to quit your job to learn about how to manage refurbs and deal with contractors and navigate HMO licensing. And honestly, I think you shouldn't have to either. And that's exactly why I work with private investors. You've seen the maths, you understand the opportunity, but you also know this takes time and expertise and boots on the ground to execute properly. That's what we do at Dan & Jim Property. You bring the capital, we bring the deal flow, the systems, the expertise, and we handle everything. Finding the property, managing the conversion, refinancing, tenanting, and ongoing management. All of it. And then we do a 50-50 profit split. You get the returns, you get the asset appreciation, and you get the cash flow without becoming a full-time property developer. If you've got $500,000 to £5 million to deploy and you want to explore working together, there's an investor waitlist in the description. Fill it in, tell us about your situation, and let's have a conversation to see if it's a good fit. Right, let me wrap this video up. So that's the infinite money glitch. Capital recycling through HMO conversions. Buy a property, convert it into a high-yielding HMO, refinance based on commercial valuations, and pull most of your capital out. Leave a small amount in that works incredibly hard for you. Then do it again and again and again. It's not magic, it's not easy, but it's exactly how professional operators scale portfolios while everyone else stays stuck. Now in this video, I've shown you how this strategy works, but I didn't cover how property compares to other places you could deploy serious capital. Stocks, gold, crypto, and property. If you've got £1 million sitting there, where should it actually go? Which one of these asset classes delivers the best risk-adjusted returns? Which one lets you use leverage properly? I break down all 4 asset classes with real numbers, and one of them absolutely destroys the others. If you want to see that full breakdown, click on screen now and I'll walk you through exactly where I put £1 million a day and why. And don't forget to subscribe to the channel, and I'll see you next week for the video.